Welcome back to Kuwaiti Dinar Analysts, the channel where we break down global oil, currencies, and geopolitics in a calm, fact-based way. If you're trying to understand why oil prices move, how global markets really work, and how major events affect money, you're in the right place. Today's topic is very important because many people believe oil prices only rise during wars. But the truth is very different. Oil prices don't need war to rise, and in this video, I'll explain the real reason why. Most people believe oil prices rise only when wars start, but the truth is far more surprising. In many cases, oil prices rise when there is no war and no bombs, no missiles, no actual supply loss. So today, we're answering a critical question. Why do oil prices rise even without war? This is not about politics. This is about how oil markets actually work. The biggest myth is this: oil prices react to events. In reality, oil prices react to expectations. Oil is traded in futures markets, where prices are based on what traders believe might happen, not just what is happening today. This means oil can rise before a conflict, it can rise during times of peace, and it can even fall during wars. What matters most is the perception of risk, not the headlines you read every day. The market is always looking ahead, trying to price in what might happen tomorrow, next week, or next month. When uncertainty increases, markets add something called a risk premium to oil prices. Think of this premium as a buffer against fear. It reflects the fear of a potential supply disruption, the fear of shipping delays, the fear of new sanctions, or the fear of political escalation. Even if not a single barrel of oil is lost, prices rise because the future supply feels less secure. It's like insurance. When the risk of an accident goes up, your insurance premiums get more expensive. Oil prices work the same way. The market is insuring itself against a future problem, and we all pay that premium at the pump. Now, let's talk about why the Middle East matters so much, even in times of peace. Many of the world's largest oil exporters are located in this one, very concentrated region. So even during periods of calm, things like military exercises, diplomatic tensions, minor shipping incidents, or even just the threat of sanctions can dramatically increase the perceived risk. The market isn't asking, is oil disrupted today? It's asking, what could go wrong tomorrow? And that question alone has the power to move billions of dollars and affect the global economy. There's another hidden cost many people overlook: shipping and insurance. A price of oil doesn't just reflect the oil itself. It also includes the cost of getting it from the producer to you. This means shipping costs, insurance premiums, and security expenses are all baked into the price. When geopolitical risk rises, tanker insurance becomes far more expensive. Shipping routes might have to change to avoid dangerous areas, which increases delivery times and fuel consumption. So even if the oil supply stays exactly the same, the cost of transporting it goes up, and that pushes prices higher for everyone. This is one of the most powerful, yet overlooked, reasons why oil prices can move without a war. So who's driving all this? Traders and the psychology of the market. Oil traders are not just guessing. Their primary job is to manage risk. When uncertainty rises, they buy oil futures as a form of protection. Airlines do the same to hedge against rising fuel costs. Energy companies lock in prices to protect their profits. This collective action increases demand in the futures markets, which in turn pushes prices higher. So oil isn't rising because barrels are disappearing from the world. It's rising because more people want to buy protection against a future problem, creating a surge in demand. Sanctions are another powerful tool that affects oil prices. And here is the key: sanctions don't even need to be officially announced to move the market. Sometimes a simple warning, a diplomatic statement, or a subtle policy signal from a major government is enough. Markets react instantly because sanctions affect future supply expectations, not just current output. Remember, oil prices are always looking forward. The mere possibility of sanctions can remove millions of barrels from the future market in the minds of traders, and prices will adjust long before any official ink is dry. And here is the great irony in all of this. Oil prices can sometimes fall during an actual war. Why would that happen? It's because markets often price in the worst-case scenario. If traders expected a massive, widespread conflict that would disrupt supply for months, the price would already reflect that maximum risk. Then, if the reality of the conflict turns out to be less damaging than feared, if oil continues to flow, prices will actually fall. This proves one thing very clearly. Oil prices move on expectations, not emotions. It's about what was priced in versus what actually happens. So, what does all this mean for you, for consumers, and for the global economy? When oil prices rise without a war, the ripple effects are huge. Inflation pressure increases because it costs more to transport everything, from electronics to groceries. Food prices follow because farming and distribution are energy intensive. Central banks become more cautious and might raise interest rates to control inflation, which can slow down economic growth. This affects everyone, even those living thousands of miles away from any conflict zone. Oil is not just an energy product. It is a global economic signal. So, let's circle back to our main question. Why don't oil prices need war to rise? Because oil markets are pricing in risk, uncertainty, expectations, and the fear of what might happen in the future, not just current supply and demand. Oil moves before events, not after them. Understanding this fundamental principle is the key to truly understanding not just oil, but the entire global economy. Before we end, remember one important thing. Oil markets don't react to emotions, they react to expectations. Understanding this helps you understand not just oil, but inflation, currencies, and global economic cycles. If this video added value to your understanding, support the channel by liking the video and subscribing to Kuwaiti Dinar Analysts. Your support helps this channel continue delivering clear, unbiased analysis without noise or fear. Thank you for watching, stay informed, and I'll see you in the next video.